Breaking news. General Motors just shocked the entire auto industry with a move no one saw coming. Massive vehicle discounts, we're talking thousands off MSRP, are now flooding dealerships across America. This isn't just a sale, it's a desperate pivot, a sign of the times, and a wake-up call to every car buyer and competitor. What's behind GM's bombshell decision? And what does it mean for the future of car prices in the U.S.? Buckle up, because this is going to be a wild ride through the biggest shakeup in the auto industry this year. Something seismic just happened in the American auto market. General Motors, yes, the giant behind Chevrolet, GMC, Cadillac, and Buick, just launched an aggressive and unprecedented wave of vehicle discounts across the U.S., and it's sending shockwaves through the entire industry. This isn't your typical end-of-year clearance event or a regional dealership promotion. This is a full-blown pricing assault that's forcing every other automaker to take notice. We're talking up to $12,000 off brand-new trucks, SUVs, and EVs. No gimmicks, no fine print, just rock-bottom prices effective immediately. So what's driving this radical move? Is GM panicking? Or is this the smartest play in a slowing, uncertain economy? Either way, what happens next could change how we buy cars forever. GM has rolled out what can only be described as a fire sale across its lineup. From the ultra-popular Chevy Silverado, which now comes with up to $10,000 in incentives, to the Buick Enclave and Cadillac XT6, which are seeing deep dealer markdowns, the deals are real, and they're happening nationwide. GM's electric lineup isn't immune either. The Chevy Bolt EV, once touted as GM's mass-market EV savior, is now being discounted by several $1,000s as GM clears out remaining stock before production ends. Even newer models like the Equinox EV and Blazer EV are showing early price flexibility. In some regions, dealerships are offering 0% APR for 72 months, bonus cash, and loyalty incentives that can add up to mind-blowing savings. These discounts aren't limited to slow sellers either. Even bestsellers are getting chopped. And the best part? This isn't a limited-time offer for Memorial Day or Labor Day. GM is positioning this as a market-wide reset, and that changes everything. So why is General Motors, a company with a market cap in the tens of billions, suddenly going full throttle on discounts? The answer is layered and, honestly, a bit troubling. First, consumer demand has dropped. With high interest rates, record auto loan defaults, and tight household budgets, Americans are simply not buying cars like they used to. Inventory is starting to stack up, particularly in segments like full-size trucks and non-luxury SUVs. GM, like many other legacy automakers, was banking on a booming EV future, but sales of their EVs have failed to match projections. Their Ultium platform rollout has been slow and marred by production delays and software issues. On top of that, competition from Tesla, Hyundai, BYD, and even Chinese automakers entering the market has squeezed pricing power. Meanwhile, Wall Street is watching nervously, with analysts questioning whether GM can hit its 2025 profit targets. In this climate, GM's leadership likely made the decision to go on offensive pricing mode, sacrificing short-term margins to protect long-term volume and market share. It's a bold bet, but one that signals real pressure beneath the surface. The reactions across the industry have been nothing short of stunned. Dealerships, many of whom are independent franchises, were caught off guard, but are now scrambling to match GM's new pricing expectations. Ford is reportedly convening emergency meetings with regional reps to assess whether they need to counter with their own price cuts on the F-150, Explorer, and Mach-E. Stellantis, already under strain with Jeep and Ram inventory pileups, may be forced into another round of steep discounting, which they can ill afford. Toyota, Honda, and Hyundai, who've maintained tighter control of supply and resisted incentives, now face the prospect of losing thousands of buyers to GM's aggressive move. Analysts are calling this the start of a full-blown pricing war, one that could collapse profit margins across the board. And that's not all. Investors are jittery, worried this signals a deep, structural demand problem. This is not just a promotion, said one Wall Street auto analyst. This is GM waving a white flag to the market and saying, we need to move cars now. For everyday consumers, this may be the best news in years. After months, or even years, of sky-high car prices, bidding wars, and dealer markups, buyers finally have real leverage again. If you're in the market for a vehicle, now is the time to start hunting. Trucks like the Silverado and Sierra are seeing some of the steepest markdowns in over a decade. Family SUVs, crossovers, and even some electrics are all fair game. And here's the kicker. If GM's discounts continue into the fall, it will put enormous downward pressure on the used car market, which is already showing signs of cooling. That means trade-in values may drop, but it also means deals across the board. Add in high dealer inventories and a growing sense of urgency to hit quarterly targets, and you've got a perfect storm where buyers can negotiate hard and win. Don't accept sticker price. Do your research, know the incentives, and don't be afraid to walk away. Chances are they'll call you back. Zooming out, what GM just did reveals something much deeper about where the U.S. auto market is headed. We're no longer in a market where demand outpaces supply. The pandemic boom is over. The chip shortage is easing. EV hype is cooling. And now, automakers are realizing that consumers aren't willing to pay inflated prices anymore. GM's massive discount program might help them move inventory in the short term, but it's also a clear sign that the industry is entering a new, more fragile era. One where profitability is harder to come by, loyalty is fleeting, and adaptability is key. For automakers stuck in the old way of doing business, with long development cycles, bloated dealer networks, and razor-thin EV margins, this could be the beginning of a painful reckoning. GM just made its move. Who's next? And can they survive a price war in an economy that's slowing fast? While customers might be celebrating these massive price cuts, many GM dealers are feeling the heat. On the surface, lower prices mean more foot traffic, but behind the scenes, it's more complicated. Dealers who bought inventory at higher wholesale prices are now taking a hit on margins. Some are calling out GM for not giving them enough warning before launching the aggressive discount blitz, leaving them scrambling to adjust advertising and financing structures. Plus, with GM focusing more heavily on online direct-to-consumer EV sales, dealers are growing uneasy about their future role in the ecosystem. And let's not forget the service departments. EVs require far less maintenance than combustion cars, so service revenue is also under threat. In short, this price drop may look like a lifeline for buyers, but it could be a noose tightening around the necks of traditional dealers. The situation becomes even more intriguing when you factor in GM's massive investments in electric vehicles. Billions have been poured into their Ultium battery platform, EV factories like Factory Zero, and new nameplates such as the Equinox EV, Silverado EV, and Cadillac Lyriq. But here's the reality. They're not selling as fast as expected. Software issues, range concerns, and charging infrastructure limitations have put a damper on excitement. Worse yet, Tesla continues to dominate, while startups like Rivian and Lucid capture niche buyers with fresher tech. GM's pricing move is also an attempt to jumpstart stagnant EV adoption, but at what cost? With each price cut, the margin on these vehicles, already razor-thin, shrinks even more. For GM, the EV gamble was supposed to future-proof the company. Now, it's starting to look like a weight dragging profits down. To understand why GM had to go nuclear with discounts, you also need to look at the macroeconomic pressure crushing both buyers and automakers. Auto loan interest rates are at a 15-year high, with some borrowers facing 8 to 10% APR or more. Monthly payments have soared past $700 on average, and the average transaction price of a new vehicle is still hovering above $45,000, completely out of reach for millions of Americans. Add in rising insurance premiums, sky-high maintenance costs, and fuel prices in some states, and you've got a recipe for demand collapse. GM's deep discounting is a recognition that affordability is now the biggest barrier to new car ownership. They can't wait for interest rates to come down. They had to act now. Another key piece of this puzzle is Tesla's pricing strategy. Over the past 18 months, Tesla has aggressively cut prices on its most popular models, slashing up to $20,000 off the Model S and X, and thousands off the Model 3 and Y. This forced legacy automakers, including GM, into a corner. How can they compete when Tesla is vertically integrated, sells direct-to-consumer, and still turns a profit? GM's price cuts are a clear response to this pressure, an acknowledgement that they can't win on branding alone anymore. Consumers are cross-shopping Teslas with everything from the Bolt to the Lyriq, and GM had to lower the price floor or risk bleeding market share. The old rules no longer apply, and Tesla has rewritten the playbook. Let's take a step back. If America's second-largest automaker is resorting to massive price cuts, with more likely to follow, are we entering an auto industry recession? Some experts say yes. After a post-COVID surge, the industry is now seeing signs of overproduction, consumer fatigue, and economic tightening. Automakers that ramped up capacity are now sitting on unsold vehicles. Even EV momentum is slowing, with demand tapering off despite generous federal tax credits. Add in geopolitical tensions, rising materials costs, and uncertain regulatory frameworks, and the auto industry looks vulnerable. GM's price cuts could be the canary in the coal mine. If demand keeps slipping, more manufacturers will slash prices, leading to margin compression, layoffs, plant slowdowns, and potentially a full-blown correction in the auto market. With any shakeup this big, there are bound to be winners and losers. Buyers who've been holding off are clearly the winners. Finally, they get to bargain from a position of strength. Dealerships, on the other hand, could be facing turbulent months ahead as floor plan costs rise and used trade-ins lose value. Rival automakers that refuse to join the discount war may lose customers in the short term, but they might preserve profitability longer. GM might gain sales volume, but if this undercuts brand value or alienates loyal customers who paid more months earlier, the long-term effects could be damaging. Then there's the aftermarket, which thrives on steady sales, and could be in trouble if the entire new car pipeline starts slowing. So what happens next? That depends on how the market and consumers respond to GM's discounts. If sales surge, GM may continue this aggressive strategy through the end of the year. If rivals like Ford, Toyota, or Hyundai follow suit, we could see an all-out pricing war that resets the auto industry for years to come. However, if buyers hold out expecting further cuts or economic conditions worsen, this bold move might not be enough to spark recovery. One thing's certain, GM has drawn a line in the sand. This is no longer business as usual. The American auto industry has entered a new chapter, and it's going to be written by pricing, not prestige. Here's what you should do right now if you're shopping for a car. Don't rush. Start by tracking dealership inventory and checking which GM models have the deepest incentives. Use third-party tools to calculate real-time dealer markups or markdowns. Visit multiple dealers, even out of state, and ask to stack rebates, loyalty cash, and dealer incentives. If you're open to EVs, now may be the best chance to get in at a historically low price. And keep watching. If Ford or Stellantis follows with matching offers, your options will expand fast. The power has shifted back to the buyer. Use it. Let's talk psychology, because behind every sale, every discount, every incentive, there's a buyer hesitating. Consumer confidence is plummeting, and that's playing a huge role in why these discounts are even happening. According to recent surveys, a growing number of Americans now say they're delaying major purchases, including homes, appliances, and yes, vehicles. The reason? Job insecurity, interest rates, and the fear of falling car values. Buyers no longer trust that the car they buy today will hold its value tomorrow. GM's discounts may spark some short-term action, but long-term, they signal that even the automakers no longer expect strong organic demand. That's a confidence crisis, not just for buyers, but for the entire industry. When GM made this move, Wall Street didn't cheer, they panicked. Shares in GM dropped following the announcement, and analysts from firms like Goldman Sachs and Morgan Stanley raised red flags about GM's profitability outlook. Why? Because pricing wars almost never end well for manufacturers. You can't slash prices without slashing margins. And once you train the market to expect discounts, you can't easily walk that back. Investors are now wondering, is GM doing this because it's a calculated strategy or because it has no other option? With global growth slowing and vehicle debt nearing record highs, the financial community is starting to whisper a dangerous word: unsustainable. One overlooked part of this bombshell is how GM's price cuts intersect with federal EV tax credits. The U.S. government's $7,500 incentive was supposed to make EVs more affordable, but it's also created massive confusion among buyers. Some GM EVs qualify for the full credit, others only partially, and some not at all due to battery sourcing rules. By slashing EV prices now, GM is essentially saying, forget the tax credit. we'll just knock off the price ourselves. That's a huge shift. But it also raises questions. If the tax credits were supposed to drive EV adoption, why is GM taking matters into its own hands? Are the credits failing? Are consumers too confused or too skeptical? This move reveals deep cracks in the policy framework that was designed to fuel the EV transition. Let's take this global. While GM is slashing prices in the US, Chinese automakers like BYD, Geely, and XPeng are building massive momentum across Asia, Europe, and now even in Latin America and Africa. BYD has already overtaken Tesla as the world's largest EV maker by volume. These brands are offering tech-packed, well-built electric vehicles at incredibly low prices, thanks to their vertically integrated supply chains and massive scale. GM knows what's coming. If they can't win the US market now, how will they compete on the world stage when these Chinese EVs inevitably enter North America? These price cuts aren't just a domestic tactic. They're a sign that GM is bracing for a global price war, and it might already be too late to keep up. There's another piece we need to talk about: GM's brand identity. Once the pride of American innovation, think Corvette, Cadillac, the old-school Suburban, GM is now struggling to find a narrative. Chevy still sells, yes, but what does it stand for? The Bolt was discontinued. Buick's lineup feels like an afterthought. Cadillac is stuck between trying to be premium and failing to deliver consistent tech. Now with discounts across nearly every brand, GM risks becoming the discount brand, the one people will buy when they can't afford anything else. That's dangerous in an age where brand loyalty is already eroding and younger buyers crave authenticity, not bargain bin deals. The company must ask itself, what kind of legacy does it want to leave? Now let's ask the question that's lurking in the background of every financial analyst report. Could GM face another collapse? We're talking about a company that already declared bankruptcy once, during the Great Recession in 2009. It was bailed out by the US government, reorganized, and rose again. But here we are in 2025, and the warning signs are flashing. High debt, slowing growth, costly EV investments, a chaotic retail network, competition from Tesla and China. If these discounts don't translate into long-term profitability, if they're just buying time, then GM may find itself once again too big to succeed in a changed economy. A second collapse isn't imminent, but it's no longer unthinkable. Zoom out even further, and you'll see that GM isn't alone. Ford, Stellantis, VW, and even Toyota are feeling the heat from a shifting global market. Consumers want more tech, lower prices, faster innovation, and legacy automakers are struggling to keep up. Their manufacturing processes are slow, their overhead is massive, and they're battling outdated dealership models while trying to compete with software-first companies. GM's price cuts could be the first domino, tipping an entire generation of automakers into a painful restructuring phase. This might be the moment we look back on and say, that's when the old system finally started to break. So here's the million-dollar question. Is this GM playing chess, or is it a desperate move in a losing game? On one hand, they've seized the moment. They're making cars more affordable, keeping factories running, and giving consumers a reason to come back. On the other, they've triggered a race to the bottom, risked their brand image, and potentially sacrificed long-term profit for short-term numbers. Only time will tell if this gamble pays off. But one thing's for sure, GM's decision has shattered the status quo, and the US auto market may never be the same again. We'll be following every twist and turn as this story unfolds, from pricing wars to market crashes, dealership drama to EV meltdowns. So make sure to like, subscribe, and hit the bell icon for the next chapter in this ongoing saga. Drop a comment. Do you think GM is saving itself or setting itself up for failure? Behind the scenes of GM's pricing bombshell is an ugly truth. Their supply chain is breaking down. The semiconductor shortage may have eased, but now GM is facing battery material constraints, unpredictable shipping costs, and logistical bottlenecks in moving cars from factory to dealership. Their Ultium platform, the centerpiece of their EV ambitions, has faced delays and quality control problems. And now, with vehicles piling up, Logistics networks are clogged with unsold inventory. Slashing prices may help move the metal, but it doesn't fix the fragile infrastructure GM has built beneath its modern empire. Let's not forget the United Auto Workers, UAW.